8 layers and 77 entries. Welcome to the Finance Iceberg. In this video, like other Iceberg videos, we're going to talk about the most well-known topics at the top, and the deeper we go, the more obscure the topics become. Bulls and bears. Bulls and bears refer to market sentiment on a certain asset, for example. If you are bullish on this asset, you believe it will go up, and if you are bearish on this asset, you believe it will go down. It's used as a sort of metaphor for market sentiment, as well as actual directions this asset will take. So bull up and bear down. Pretty simple. Rule of 72. The rule of 72 is an investment formula used to calculate the number of years it will take to double your investment. If you take 72 divided by your annual returns, you should get the number of years it would take for you to double your investment. But it's not a flawless formula, and its effectiveness differs depending on your average returns. Compounding. This is probably the most well-known phenomenon when it comes to investing. If you invest $10,000 with an annual return of 10%, in 10 years you would have had $26,000. If you know basic math, this concept is pretty self-explanatory. Depending on your initial investment, your annual returns, and how much time you have, compounding can actually make you pretty wealthy. Wall Street. Wall Street is, you guessed it, a street located in New York, and is the home of the largest stock exchange in the world, the New York Stock Exchange, as well as several banks and investment firms. Wall Street is not only the central place for American finance, where financial institutions flourish, it's also earned a pretty accurate reputation of amplifying degenerate greed and fraudulent behavior, the Wolf of Wall Street and Bernie Madoff being two of the most notorious examples. We will talk about those a little deeper down the iceberg. IPOs. IPO stands for Initial Public Offering, where a company offers up shares that are then listed on a stock exchange, thus making the company go public. This act makes it so that retail investors like you and me can effectively go on a broker like Robinhood and invest in that company. And there are several reasons as to why you would do this. The biggest reason is to raise extra capital through retail investors, but there are also downsides like the legal requirements for extra accounting. Dogecoin. Dogecoin is a cryptocurrency based on the popular meme Doge. It was originally created as a joke to effectively make fun of crypto. Ironic how it is now one of the largest cryptocurrencies out there. It gained widespread popularity through Reddit, Twitter, and Elon Musk, and it single-handedly spawned a plethora of other meme coins like Pepe and Shiba, but Dogecoin is widely considered to be the first meme coin. LIBOR. LIBOR stands for London Interbank Offered Rate, and it was an interest rate composed of short-term loans between banks based in London. It was basically used as a sort of collateral rate a bank needed to have in order to make money from their issued loans. You can kind of compare LIBOR to the current federal funds rate since it had a similar role. We don't use LIBOR anymore, and we will talk about that deeper down the iceberg. Origins of capital markets. This entry refers to how capital markets like the stock and bond markets came to be. The bond market started out in 12th century Italy as a way to get the rich elite into pooling their money into the government, since they didn't have enough money to fund whatever they needed to fund, which was at the time mostly war. So the rich invested money into the government and were promised interest in return. And this worked so well that it eventually grew into the modern day bond market. The stock market is a similar story, but instead of the government pooling money, it was private businesses. It was actually the Dutch East India Company that came up with the idea to pool equity into their company to fund whatever the company needed to fund, which was mostly colonization, and this created the first publicly traded stock, the Dutch East India Company. Derivatives. Simply put, a derivative is a financial product that you can buy that moves based on an underlying asset. So you essentially buy a product that tracks an underlying asset while not exactly buying into the asset itself. This includes all sorts of products like futures, trackers, and options that work in a plethora of different ways. A common use for derivatives is lumping them together to form products with leverage. This is why derivatives are commonly associated with excessive amounts of risk, so much so that entire banks and hedge funds have collapsed because of it. Trust me, this won't be the last time we'll bring up leverage in this video. Gold standard. The gold standard was a system that many economies had in place for a very long time. The gold standard meant that every dollar or yen or pound was tied to a fixed amount of gold. This essentially meant that you could go to the bank and trade in a certain amount of cash and get gold in return. The gold standard was effectively terminated by President Nixon in 1971, creating a more efficient flow of money throughout the economy. This was great for financial growth since money was more available, but it also caused caused inflation to be more volatile, as well as decreasing the dollar's value over time. This decline is a growing concern, but given the dollar's dominant position in global trade, it's not like it's going away anytime soon. Ponzi finance. This entry refers to a financial system that only works if people put in more money than they take out. This essentially creates a loop where you pay people back with money that you get from other investors, and unless you actually pay people back in legitimate ways, this system will likely fail. Ponzi finance is illegal in many ways since it's not really sustainable. The name comes from one of history's most notorious scammers, Charles Ponzi, who promised investors great returns, but the only way he delivered on those returns was to pay people back with money from other investors. Another famous Ponzi scheme was the Bernie Madoff scandal. This is probably one of the largest Ponzi schemes of all time, scamming people for $65 billion before getting caught in 2008. Ponzi schemes are more common than you might think, so if something sounds too good to be true, it likely is. OPEC. OPEC is essentially a cartel whose main objective is to control and manipulate the oil market. The organization consists of Saudi Arabia, Venezuela, Iran, and other massive oil producers making up 80% of the world's oil supply. This makes them very powerful politically, and their methods have been questioned time and time again. Cartels are generally illegal since manipulating prices of a certain product goes against every rule of a free market, but they have so much power that they can kind of get away with it. Yeah, OPEC is a pretty shady and corrupt organization. The amount of scandals and controversy they've been involved with is a whole video in and of itself. Hedge funds. A hedge fund is a fund consisting of a bunch of portfolio managers who invest on the client's behalf, often to try and beat the market. Some hedge funds tend to have large appetites for risk, which makes them either really successful or complete failures. They tend to use instruments and derivatives that are only available for major institutions, and they only accept clients who make a lot of money. So in a lot of ways, they represent greed and privilege for the wealthy, which in my opinion isn't completely unfounded. Pork bellies and orange juice. This is quite an obscure one. It essentially refers to futures contracts and how ridiculous this sort of trading can be. Futures are financial derivatives, which we mentioned earlier, and they are essentially a contract where you set a fixed price a certain asset will sell for in the future. It's a very common contract when it comes to commodities, since many commodities tend to be pretty volatile, and with a futures contract, you don't really have to worry about that. Pork bellies and orange juice have historically been the most popular commodities traded with futures contracts, and it just goes to show that traders are literally willing to bet on pigs to make money. It's just kind of weird. Short selling. A very common tool for institutional investors. Short selling is when you borrow an asset and then sell it in hopes of buying it back in the future at a lower price. So you make money on an asset losing value, pretty much. When it comes to investing, shorting is considered very risky since not only does the asset need to lose value, it needs to lose a lot of value since you also need to pay very high amounts of interest. However, many would argue that short selling is actually good for the market since it allows for honest pricing. Even if a company tries to hide its flaws, short sellers are often quick to point them out, which leads to a more honest market. MOMO. MOMO, or momentum investing, is an investment strategy that revolves around buying what's currently going up and shorting what's currently going down. A sort of ride the wave strategy. It might sound like a beginner level strategy, but it's actually been proven to beat the market fairly consistently. There's a very common trend for successful investment strategies like this. They work until they don't. And this one is no different. One small misstep in a strategy like this could mean massive losses, so be careful. By the way, I made a video on similar investment strategies, so if you're interested, check that out after the video. Share buybacks. This is exactly what it sounds like. It's when a company buys its own shares, and there's several reasons as to why this happens. The first one is tax purposes, since it's more tax efficient to have more stock than getting paid in dividends. The second reason is expectation. Dividends often raise expectations, and buybacks tend to signal that the company is undervalued, making buybacks smarter politically. But the biggest reason is to move assets from the company to the shareholders, which is really what company owners want. But what do you prefer? Do you want your investments to signal buybacks or pay dividends? Let me know in the comments. Robinhood. Robinhood is a very popular stockbroker for retail investors, but there's a couple reasons as to why it stands out from other stockbrokers. After the infamous GameStop squeeze in 2020, it sort of became a symbol for fighting back against the greed of Wall Street, partly because of its name, Robinhood, stealing from the rich, giving to the poor, but also since most people who bet against GameStop did so on Robinhood. In fact, it's responsible for many similar incidents. But that's not the only thing Robinhood is known for. They also have an unbelievably sloppy system, which many people have taken advantage of. One user on Reddit borrowed $50,000 with no collateral. You can pause the video and read if you want to know how he did this, but just to let you know, you can't do this anymore. Tulip mania. This entry refers to the first recorded speculative bubble. Back in the early 17th century, tulips were regarded as a very luxurious and exclusive item, and the Dutch became completely infatuated with the flower, and the price soared. It became a sort of collector's item. There were entire markets, and people were suddenly lining up to buy all sorts of tulips. But here's the thing. Tulips don't really have any sort of intrinsic value. It's just a pretty flower. So when the tulip hype died down, so did its price. Tulip mania was really just a massive hype train, and it just goes to show how powerful demand can be in the economy. Taking delivery. We talked about futures contracts earlier, and taking delivery is essentially a futures contract where you actually take the physical underlying. For example, if I have a futures contract for 100 barrels of oil, on the contract's due date, I would get 100 barrels of oil delivered to me. It's not exactly common, but there are instances where this could be useful. For instance, if you want the physical asset for investing reasons perhaps, then by all means go for it. Just be careful so you don't accidentally buy a futures contract where you're stuck with 500 pork bellies in your garage. Because if you own a futures contract that takes delivery and then forget to exit the position before its due date, it might cause you a few problems. SPACs. SPACs, or Special Purpose Acquisition Companies, are public shell companies whose purpose is to acquire a private company. So it's effectively an alternative to IPOs, which I mentioned earlier. The difference being that with SPACs, you don't have to go through the whole IPO process. The public shell company just buys the private company and that's it. So it's a lot faster, but they are generally not as trustworthy as an IPO, since SPACs are renowned for occasionally giving unfair deals to insiders. This makes them pretty risky for retail investors, as it's essentially just a faster and more speculative way for a company to go public. However, SPACs have come under fire for the previously mentioned high rate of inside trading, which has historically led to several high-profile investigations conducted by the SEC. This certainly raises questions whether the current guidelines are enough to keep illegal affairs away from these types of acquisitions. Zero Hedge. This is a far-right news outlet and financial blog known for being very anti-establishment and its constant pessimistic outlook on the market. The site was launched in 2009 by former hedge fund manager Daniel Ivanjiski, going by the pen name Tyler Durden. It started out as an overly pessimistic financial blog, over time expanding into more of a far-right political platform. It's even been accused of spreading conspiracy theories and pro-Russian content. It's never been particularly accurate in its predictions, which is presumably why it's more political nowadays. Cayman Islands. A nice vacation spot for some and a tax haven for others. 0% inheritance tax, 0% property tax, and 0% income tax is exactly why there are more companies registered in the Cayman Islands than there are people. Businesses like hedge funds are especially profitable here since they allow their clients to operate under their native tax laws. All of these tax advantages have unfortunately led to a few money laundering issues, which comes with the territory of being one of the largest tax havens, I guess. MMT. This entry refers to the modern monetary theory, which is a pretty radical economic theory where government spending and cash circulation gets turned on its head. If your country has a free currency like the United States, you basically print and spend money until inflation goes up, and when it does, you don't lower it by raising interest rates, you lower it by raising taxes. This theory has been heavily criticized by economists, many of them stating that it would inevitably lead to hyperinflation, and it's not hard to see why. Government spending is certainly needed, but solving every problem with printed money is definitely a long shot. Quantitative easing. Quantitative easing is a central bank buying a bunch of assets, mostly bonds, which leads to a lot less pressure on financial institutions, making interbank lending easier. It's a monetary policy used as a last-ditch effort during a recession by simply taking debt from financial institutions and placing it on the Federal Reserve balance sheet. This and rate cuts are two of the most efficient ways for central banks to stimulate the economy in times of low or even negative inflation. The only times you would implement a drastic measure such as quantitative easing is in times of real desperation, such as the Great Recession. Carried interest. This is a share of the profits made by an investment firm that specifically goes to the investment manager. It's similar to a commission for investment managers, but with one small difference. You don't pay taxes, or at least not a whole lot. Carried interest gets taxed as capital gains instead of normal income, and this has been heavily criticized for favoring the rich, and it's pretty clear why. There's really no reason as to why this shouldn't be taxed as normal income. Your returns aren't really going anywhere, and it's not like paying no tax on it is gonna incentivize larger returns. But that's just my opinion. Let me know if I'm wrong in the comments below. China as a currency manipulator. Even though this might sound like a conspiracy theory, it's not as crazy as it seems. Despite being the second largest global economy, many people believe China is deliberately keeping their currency as low as possible in order to incentivize exports. And this is actually true to some extent. The Chinese yuan was pegged in 1997, and for those of you who don't know, a currency peg is setting a fixed exchange rate that prevents your currency from increasing in value. And since they did this back in 1997, their export industry has flourished. But since China's economy is relying so heavily on exports nowadays, this also leaves them open to things like tariffs. Another questionable way they manipulate their currency are strict measures of capital control, meaning you can't move your money freely in and out of the country. So does China manipulate its currency? Yes, but there are certainly downsides that come with it, and it's definitely not the only country to do so. Don't fight the Fed. A popular slogan that essentially refers to the immense power the Federal Reserve has over America. A single monetary policy from the Fed can single-handedly make or break the entire economy. This is why a single sentence from Jerome Powell can cause a 4% decline in the stock market. So you should never really make a trade that goes against their interests, because if the Fed backs the economy, it will eventually go up, and if they don't, it will eventually go down, and there's nothing you can really do about it. Sell-side analyst. A sell-side analyst is someone who evaluates companies on behalf of the firm they are working for. They are typically the ones who place buy, sell, or hold recommendations on a stock. Most of the time, they work for either investment banks or brokerage firms, which can sometimes lead to conflicts of interests. It's not completely uncommon for sell-side analysts to encourage people into buying something in the firm's interests. This is a slippery slope and hard to prove, and I'm not saying all sell-side analysts do this, but there are some notorious cases like Jack Grubman and Henry Blodgett. VC herding, an investment theory revolving around financing startups, IPOs, and small businesses. However, businesses who have massive long-term growth potential are inherently really hard to find, and even if you find one with growth potential, venture capitalists, who often move like a herd, can easily make those companies overvalued, essentially making them pump and dump penny stocks. The startups that stand out here are companies like Google, Amazon, Apple, but the chances of you investing in a company like that are basically slim to none. Sorry to break it to you. John Law. One of the most renowned economists of all time, John Law is kind of known as the father of modern finance, creating the first fractional reserve bank, which is a system we use to this day. He's also responsible for creating one of the earliest examples of an economic bubble. He was an early investor in a business known as the Company of the West, which effectively owned the state of Louisiana. He came up with a marketing scheme to attract capital in the company, which worked a little too well. He greatly exaggerated the value of the company, and when investors realized this, his bank collapsed soon after. He did go down in history though as the father of modern finance. LBOs. LBOs, or leveraged buyouts, is a company acquisition using mostly debt. A company takes on a mountain of debt, effectively using both companies as collateral. Yes, it's a buyout where your company can get bought using itself as collateral. This is why LBOs are considered very hostile, because there's really not a whole lot you can do. A good example of a leveraged buyout is Twitter, where Elon Musk just sort of took on a lot of debt using Tesla stock as collateral, and there wasn't really a whole lot Twitter could do about it. But if a buyout fails, you're in trouble, because you're then stuck with a lot of unsustainable debt and a lot of interest costs on top of that. So not only is it extremely hostile, it's also very risky. Tesla Q. Speaking of Twitter and Elon Musk, we also have Tesla Q, which is a group of short sellers renowned for their harsh critique of Tesla and Elon Musk. Many of them believe Tesla is a fraudulent company and that the stock will eventually crash. Criticizing Tesla is certainly justified to some extent, especially since we know Tesla has done some questionable things in the past, but there are unfortunately Tesla Q members who have taken things a little too far, like with Randeep Hothi. In 2019, Tesla filed a restraining order against Hothi after allegedly harassing employees. Remember, critique is all well and good, just do it respectfully without harassing people. Taleb's turkey. This entry refers to the turkey analogy popularized by Nassim Taleb. A turkey gets fed and cared for their whole life, until it eventually just gets slaughtered. Or at least, that's the analogy. So how does this apply to finance? It's essentially when an underlying steadily goes up over time and then very suddenly just crashes. A good example of this is the XIV, which I talked about in this video. The idea of Taleb's turkey is mostly just unreasonable fear in your mind, but there are definitely cases where the idea came to fruition. I mentioned the XIV, but it can also be applied to something as grand as the 2008 financial crisis. This analogy certainly keeps us on our toes, but if something like this were to happen to the stock market, it, there's really nothing you can do anyway, so I wouldn't stress about it too much. Zombie companies. A zombie company is a company that only exists through debt. They can pay interest on their debt but not repay the debt itself, so they're basically in a sort of undead state, which is where the term zombie company comes from. The problem is that companies like that are not profitable. They barely have enough money to pay off their debt and stay afloat, so they just take up space in the economy. Having a large amount of zombie companies in the economy is considered very damaging for financial growth, so much so that they were considered to be one of the root causes of the Japanese financial crisis in 1990. Jekyll Island. Jekyll Island is a small place off the coast of Georgia where bankers and senators first drafted the idea of the Federal Reserve in 1910. There's a lot of conspiracy theories around Jekyll Island, mainly because of the fact that they did this in complete secrecy. The simple fact that the Federal Reserve had its origins in a sacred meeting between the elites is the reason why people question the Fed's legitimacy even to this day, especially since they have so much influence throughout the economy. GME and meme stocks. A famous internet joke popularized by a subreddit called Wall Street Bets, who decided to pump heavily shorted stocks using options on Robinhood. This was basically retailers fighting back against Wall Street, creating a cycle of short sellers buying back their shorted positions. GameStop, AMC, and Bed Bath & Beyond are a few examples of these heavily shorted companies who gained a lot of attention for this. But remember, this whole thing is technically illegal, so maybe keep that in mind. Plunge Protection Team. This entry refers to a small group of powerful people who operate behind closed doors to try and stabilize the market whenever there's a significant decline. The Plunge Protection Team was created by Ronald Reagan back in 1987 as a response to the Black Monday crash. The group consists of the President, the Secretary of the Treasury, as well as the Chair of the Federal Reserve, the SEC, and the CFTC. There's a lot of controversy about the team. Many people think they possess a disproportionate amount of power and that they often do things beyond their legal mandate. The fact that they operate behind closed doors and aren't legally accountable for what they do is certainly a fair justification for concern. Petrodollar. A petrodollar is simply just US dollars earned through oil exports. There are many countries that peg their currency to the dollar, especially in the Middle East. There are two reasons for this. The first one is currency stability. The second one is the most important resource in the Middle East, oil, being traded in US dollars. The oil market being dominated by the dollar has been questioned several times, and there's a popular belief that since oil is still one of the most important natural resources, if the dollar's importance in the oil market were to falter, it could be the end of the dollar's global dominance. Don't get me wrong, the dollar's grip on oil is certainly faltering, but like I said with the gold standard, the fear of its dominance coming to an end is, in my opinion, greatly exaggerated. Chapwood. This is an index that supposedly reflects a more accurate measure of inflation. Created by Ed Butowski, the Chapwood Index reports the price increase on the 150 items most Americans spend their money on after tax. It's essentially a more conservative outlook on inflation, and it stems from the idea that CPI and core CPI is inherently misleading, and that actual inflation is much higher. Some people believe Chapwood is far more accurate, and some people believe it's straight up deceptive. Leave your opinion in the comments below. The impossible trinity, a concept which in this case applies to international economics. A central bank wants to have a fixed foreign exchange rate, free capital movement, and an independent monetary policy. But here's the thing, you can have two of these, but not all three. If you were to have all three at the same time, your currency would eventually collapse. Let's take America for example. America has an independent monetary policy and free capital movement, but not a fixed exchange rate. That's why there's access to a forex market. If we take China for example, they have a fixed exchange rate and an independent monetary policy, but extremely restrictive capital movement, like I mentioned earlier. If we take a third example like Singapore, who has a fixed exchange rate and free capital movement, you need to have the same interest as the borrower. Otherwise, you'll create uncertainty in your currency. Japan tried to have all three of these, but eventually had a massive financial crash in the 1990s that sent the yen on a downtrend, which is still ongoing even to this day. I know this whole concept sounds pretty complicated, but when you understand the components to this theory, you'll realize that it actually makes sense. Rothschilds. Probably one of the wealthiest and most powerful families of all time. There's a lot of conspiracy theories revolving around the Rothschilds, mainly due to their Jewish heritage. They started out as bankers in the early 19th century, quickly spreading their influence throughout Europe. As their banking empire grew, so did their family. It grew so much in fact that they're still around even to this day. Their family tree covers almost 300 years, which certainly leaves plenty of room for speculation about what they've been up to in that time. Let's just say I'd be surprised if they have a clean record. Survivorship bias. This one is very interesting because it doesn't apply to just finance. Survivorship bias is essentially statistics and assumptions where you concentrate on something that passed a certain process or selection while completely overlooking what didn't. World War II planes are a common example of this. This picture shows where a plane could get shot and still make it back to base, only your information is based on the planes that made it back to base and not the ones who were destroyed. In finance, this can apply to the amount of hedge funds beating the market, but not taking into account those who went bankrupt, and so it essentially shows a statistical misrepresentation of probability. Survivorship bias is dangerous, so if you try to use any sort of statistic to prove a point, remember that it can be misleading. Mansa Musa. Mansa Musa was an African king who ruled over ancient Mali, and he is widely known as the richest person of all time. His wealth came from his kingdom controlling and taxing most trade in the region, as well as conveniently having the largest gold mines. Essentially, everything the kingdom owned and controlled was his and his alone. His wealth was so vast that there's really no quantifiable way of describing it. During his pilgrimage to Mecca, he allegedly spent so much gold that businesses, cities, and even entire economies went bankrupt just as a side effect of his spending. So if you thought Elon Musk was rich, think again. Financial repression. This refers to policies that channel funds from the private sector, often to reduce government debt. It's basically the government pegging low yield rates during high inflation. This makes savers earn less money on issued government bonds, but the government can borrow money at extremely low interest rates, effectively limiting economic growth while strengthening the government. Financial repression is heavily criticized as it's essentially the government suppressing people financially in order to gain from it, and most people don't even realize it's happening. However, it can also be a good thing. For example, having a government with a strong balance sheet during bad times is extremely important since we don't want the government to collapse under too much pressure. Crassus' fire department. Crassus was a general who became one of the wealthiest men in ancient Rome, but it's how he became wealthy that's worth talking about. Crassus owned a fire department, and once a house caught fire, he would send in slaves to put out the fire. However, he would only do it if the owner sold his house to him. He would then fix the house and sell it back to the original owner at a higher price. Easily one of the most ruthless money-making schemes of all time. Volmageddon. After the 2008 financial crisis, it became exceedingly popular to short volatility, since volatility tends to go down over time. And for the following years, this was a very successful investment strategy. But this would all come to a swift end on February 5th, 2018, when the market suddenly dropped 5%, causing a chain reaction where volatility would skyrocket, and products that inverted volatility like the XIV would implode on itself due to being heavily leveraged. The volatility trading strategies never quite recovered from Volmageddon despite it being almost 7 years ago now. It's a typical example of Taleb's Turkey that we talked about earlier, and it really highlights obscure risks that we wouldn't notice otherwise. China's House of Cards. This is the simple idea that a lot of China's economic data isn't real. After all, they are a dictatorship with constant surveillance of their population and an iron fist around their economy, so faking some of their data is certainly in the realm of possibility. We know China is meddling with their GDP numbers. They constantly finance useless projects. A good example of this is China constantly building property that no one uses. Their national debt is likely even higher too. The big problem here is that we don't know the magnitude of this issue, but it is likely that China's current recession will make things a little more transparent, for better or for worse. Archegos and ARK. This entry refers to two of the most speculative investment firms in modern finance, Archegos Capital Management and ARK Investments. Archegos was managed by Bill Wong, who caused the firm to collapse due to heavily leveraged positions. The collapse of Archegos is considered to be the single largest trading loss of all time, but before it collapsed, he provided seed capital in Cathie Wood's investment fund that would come to be known as ARK Investments. Despite Cathie Wood being a pretty well-known investor nowadays, this was a highly suspicious move, especially considering they've known each other for a long time. So while many people think there was something suspicious going on behind closed doors, this was most likely just a friendly gesture. Davos. Davos is a very small town in eastern Switzerland. It's an alpine ski resort with a beautiful landscape. But perhaps the biggest reason as to why it's well known is because it's the host for the World Economic Forum, an annual meeting where the world's most powerful people engage in various agendas. As you can probably guess from that description, this place is a breeding ground for conspiracy theories. The stuff that they propose is well-intentioned but incredibly polarizing, which we'll get into later. But luckily, these suggestions are just that, suggestions. They're so unbelievably controversial that if any of them were ever implemented, they would cause complete outrage to say the least. George Soros. George Soros is known for two things. He is one of the best forex traders of all time, and he is also one of the most controversial figures in American politics. And that says a lot. George Soros first rose to prominence when he very accurately shorted the British pound in 1992, correctly predicting the Black Wednesday crisis. This short alone made him a billionaire, and he has since donated the majority of his wealth to various political and charitable causes. Soros is a massive supporter of liberal and progressive ideas, and the main reason he's controversial is that he's considered pretty radical even amongst his fellow liberals. He is easily one of the biggest donors for the Democratic Party, and this has made many people suspicious of Soros having some sort of secret agenda. I personally believe that if someone were to donate the vast majority of their billion-dollar wealth to charitable causes, you're at least doing something right. Bitcoin origin myth. Probably one of the most mysterious entries on this iceberg. Despite Bitcoin gaining massive popularity in recent years, its origins still remain a giant mystery. No one really knows who created Bitcoin, only that they go by the alias Satoshi Nakamoto. But there are a few things we know about Satoshi. For starters, we roughly know when and how he created Bitcoin, as well as a few identifying characteristics, like his programming skills, his age, and a hint of his political views. The most likely suspects so far being Hal Finney and Nick Szabo, but the true identity of Satoshi Nakamoto is still unknown. Satoshi holds roughly 5% of the entire Bitcoin supply and has done so ever since it was created. This would put Satoshi's net worth at $80 billion. Some would say this gives Bitcoin a sense of security, while others would say it's a giant risk. Regardless, it is pretty weird how one of the biggest assets in the world has a completely unknown creator. Rogue traders. These are traders employed at a financial institution who make unauthorized trades and often try to cover it up. There have been instances where rogue traders were responsible for losing their company millions, even billions of dollars in some utterly retarded ways. The most notorious example of this is Nick Leeson, who brought down his whole company through numerous index trades, resulting in a $7 billion loss, and later went to prison. It's honestly hilarious when you think about it. I mean, this guy was paid $42,000 a year for his fucking trading, when he literally would have been better off doing absolutely nothing. That says a lot about cutting your losses. The Great Reset. I mentioned the World Economic Forum earlier, and when I said that they can come up with some pretty controversial ideas, this is exactly what I was talking about. The Great Reset was a COVID recovery plan proposed by the World Economic Forum with the intention of creating a more sustainable world. They would do this through a stakeholder economy, prioritizing social and environmental development, which sounds all well and good. The problem came with their horrible marketing, as well as some of their members using very alarming terms such as "you'll own nothing and be happy." I mean, you're basically asking for controversy at that point, especially by calling it the Great Reset. At the end of the day though, I don't think this was a genuine attempt at a new world order or anything like that, but rather an eye-opener to more sustainable ideas, which I think they succeeded with. Hillary Clinton trading cattle. In 1978, Hillary Clinton engaged in numerous trades revolving cattle futures, which promptly came to an end after 10 months. During that time, she had managed to turn $1,000 into $100,000, a whopping 10,000% gain in just 10 months, easily making her one of the best traders of all time. These gains were made through short selling during a time where cattle prices actually doubled. This was obviously very suspicious, and her close ties with the meat distributor Tyson Foods made the possibility of this being an inside affair very likely, which would come back to haunt her when she ran for president in 2016. The likelihood of this kind of trade was estimated to be 1 in 31 trillion, so to say that this was very suspicious is certainly an understatement. Confessions of an Economic Hitman. This is a book published in 2004 written by John Perkins. It covers a lot of his career as an economist with consulting firm Chastity Main. Their goal was to allegedly convince leaders of underdeveloped countries to accept loans for financial development. The reason they did this was to trap them in a cycle of debt, thereby making them heavily reliant on American funds. These were very serious allegations since it was essentially colonialism, and as you can probably imagine, this book was highly controversial, many calling John Perkins nothing but a fraudulent conspiracy theorist. That's not to say that modern colonialism isn't real, but it's pretty safe to say that the lack of evidence for John's claims will unfortunately keep their legitimacy a mystery. Swiss banking. Swiss banking is a very controversial term, and there are many reasons for that, so let's start by explaining how Swiss banking actually works and why it's popular. Due to Switzerland's historically neutral stance in foreign conflicts, it's earned a pretty welcoming reputation for foreign investors. This is because a neutral stance protects your money in times of international crisis. Couple that with confidential bank accounts and high secrecy, and you have a recipe for a very lucrative lucrative banking system. In 2018, it was estimated that Swiss banks held roughly $6 trillion of cross-border assets. That's 25% of all offshore assets, a lot of which was placed there for tax evasion and money laundering purposes. Luckily, it's not as popular as it used to be, partly due to the Foreign Account Tax Compliance Act passed in 2010, but also the collapse of Credit Suisse causing Switzerland to lose a lot of its credibility. Switzerland is still a massive banking center to this day, but their glory days are probably behind us. Charlie Munger. Renowned for being one of the greatest investors of all time, Charlie Munger and Warren Buffett made an impact on the finance world by consistently beating the market for many years through their holding company Berkshire Hathaway. Charlie Munger's immense wisdom is a source of knowledge and inspiration for countless investors all over the world. Not only was he a great investor, but also a generous philanthropist, donating a large portion of his wealth to charitable causes. May he rest in peace. Panama Papers. This was a massive leak back in 2016 containing 11 million financial documents. The documents came from a Panamanian law firm called Mossack Fonseca. Their main task was to hide their clients' assets for tax evasion purposes, and they had thousands of clients. Many of them were extremely influential politicians and public figures, which is why this leak was so alarming. Some of these were the Qatari royal family, the former Icelandic prime minister, Lionel Messi, Jackie Chan, even the Mexican drug cartel, and that's just the tip of the iceberg. The Panama Papers serve as a very necessary reminder of how deep financial corruption truly goes. I mean, you wouldn't expect someone like Lionel Messi or Jackie Chan to be frequent tax evaders, but apparently they are. And this leak was, in my opinion, a major accomplishment in data journalism. One-trick ponies. One-trick ponies refer to companies that provide something, but only in a very specific niche. If this niche is small enough with a lot of competitors, the company might find it difficult to survive in the long run. When you invest in a company, you generally want to consider their competition, and this is especially true when it comes to technology. Companies like Google or Apple are valuable not only because they make a lot of money, but also because they are the best at what they do in their respective fields. A good example of a one-trick pony is Fitbit. They have a very specific niche, which is smartwatches, but they ultimately couldn't compete with Samsung or Apple, which is why they are now owned by Google. Investing in one-trick ponies is just an unnecessary risk, and you'll ultimately be better off putting your money in larger, more established companies. Iraqi dinar. Iraq's national currency is known for being extremely unstable, and if you take a look at its history, it's pretty clear why. It's one of the worst performing currencies in the world due to its heavy ties with financial and political turmoil. From the UN sanctions in 1990 to the US invasion in 2003, Iraq's been plagued with political uncertainty for the last 40 years, and this means there's very little demand for dinars. Thus, there's often an extremely high exchange rate attached to the currency. So not only is the currency connected to a country with little to no exports, it's basically internationally unviable due to its extremely high exchange rate. You should begin to see why the Iraqi dinar holds little to no value. This is why fraudulent exchange services are pushing the idea that the dinar will increase in value in the future, which, let's be honest, it probably won't. Goldman conspiracies. Goldman Sachs is one of the largest and most powerful investment banks in the world. Unfortunately, they have a long list of public controversies. For example, their close relationship with the federal government is heavily criticized due to alleged cases of insider trading. They've been accused of profiting from the 2008 financial crisis, hiding foreign debt, tax evasion, and even war profiteering. With all of these cases, it's no wonder why Goldman Sachs is a major target for conspiracy theories. Are these illegal actions strictly for profit, or is there some sort of secret agenda behind it all? I can't tell you the answer, and unfortunately, Goldman Sachs is not the only bank to engage in corrupt activities. You'll see what I mean. The barter myth. At the dawn of modern society, we didn't really have a monetary system to speak of, so we had to rely on barter. Barter is essentially just exchanging one product for another, and despite humanity relying on barter for most of our existence, modern trade is so intricate that if we were to strictly rely on barter today, we would have a considerably weaker economy. That's not to say that barter doesn't have its uses. It's a viable alternative when money is in short supply, and can be used as a last resort in order to complete an uncertain trade, but it leaves a lot of leeway. It's a common theory that we can rely on barter, but we can't. There's no direct measure of value, and this leads to many inefficiencies with the system. The goods would have to be of the same exact value, and in the long run, that's pretty much impossible. There are many modern problems with barter, which is why it's considered a myth. 14 up and 4 down. This entry refers to the Strauss-Howe generational theory. According to the theory, the market undergoes repeating cycles of 14-year uptrends followed by 4-year corrections, and for the last 150 years, notice, this pattern has been extremely consistent. Despite this, it tends to fall under the radar mainly because the phenomenon is difficult to explain. The main consensus is that it's associated with generations transitioning in and out of the workforce. A particular generation takes roughly 4 years of them getting used to a newly acquired career. Then, after 14 more years, they switch careers and get replaced by a younger generation, and the cycle continues. Not only is this pattern consistent with careers, but also financial markets like real estate. However, you need a lot more than just a recurring pattern to make the theory more financially applicable. And this is something very important to keep in mind. The business plot. The business plot, also known as the Wall Street Putsch, was a political conspiracy attempting to overthrow President Franklin D. Roosevelt and replace him with fascist dictator Smedley Butler. Roosevelt was considered a giant threat at the time due to his highly controversial campaign. He was considered by many conservatives to be a devout socialist, and his progressive political views was the main reason behind the formation of the business plot. Luckily, this plot never came to fruition, but imagine what would have happened if it did. Joseph Kennedy. Joseph Kennedy, the father of John F. Kennedy, was an American politician and the patriarch of the Kennedy family. He is also known for his precarious inside trading. In fact, that's how the Kennedys made their family fortune in the first place. Before Joseph became a politician, he made today's equivalent of $4 billion by shorting stocks during the Great Depression. Some was believed to have been through insider information, but no one really knows. Besides, he frequently utilized inside trading earlier in his career, and he could get away with it because it was legal back then. I mean, profiting from other people's financial suffering is bad enough, but doing it through inside trading is arguably even worse. HSBC. The Hong Kong and Shanghai Banking Corporation is a British bank based in Hong Kong, known for being one of the most corrupt banks in the world. If you thought Goldman Sachs was bad, just wait until you hear about HSBC. That bank has done some extremely alarming stuff. There's the $3 billion currency scheme in 2016, the tax avoidance scheme in 2015, the housing crisis settlement in 2018, war profiteering. I could go on and on. But the biggest scandal is probably the Senate investigation. In 2012, reports came out that HSBC had been lending and laundering money for the Sinaloa drug cartel. This led to one of the largest bank settlements in history at $2 billion. That might sound like a lot, but compare that to the $16 billion profit they made the year before, and you'll realize that $2 billion is really just a slap on the wrist. It's crazy how some of these large banks can get away with some pretty awful shit with little to no consequence. Bermuda Boys. I'm gonna be honest, I have no idea what this is. If any of you know what this could refer to, leave it in the comments below. Exotic options. Exotic options are options traded over the counter, which essentially means that the options are traded directly between two parties without supervision from a third party, like a stock exchange for example. Exotic options are generally more complex than regular options. They can even be customizable to fit your investment strategy and personal risk tolerance. Some might have a different payment structure, some might have niche underlying assets, some might have different triggers that determine when it can be exercised. These types of derivatives generally fly under the radar due to the convoluted nature of acquiring them. Despite this, it's considered to be a pretty good investment, at least with the right strategy in mind. Old money nobility. This is a rather obscure topic, and it refers to people and families who made their fortunes centuries ago and to this day manages to maintain their fortune either through different trust funds or investments. A few notorious examples are the previously mentioned Rothschilds, as well as the DuPonts, the Cargills, the Vanderbilts, and the most controversial one being the Rockefellers, and we'll talk about why later on. Old money families have received a lot of critique for several reasons, mainly due to their family history. Many members of these families have done some pretty bad stuff throughout history, ranging from illegal business practices to straight up murder. Considered by a large part of the general public to be relics of the past, they still hold a large amount of financial and political power. Quantum finance. Quantum finance simply refers to the use of quantum computers to predict the outcome of the market, but there's a lot of speculation surrounding how effective this really is. Some people just see it as advanced mathematics applied to investing strategies, which is nothing new, but some believe that the extremely advanced calculations provided by quantum computers are the sole reason for why massive institutions are as successful as they are, providing an unfair advantage against retail investors. This doesn't really make sense because compared to the market, institutions that use quantum computers tend to underperform anyway. I gotta be honest, I don't know enough about quantum computers to determine their overall effectiveness, but I do know that this technology is currently progressing at a rate we've never seen before, so even if the technology is still in its early phase, there's still researchers claiming that quantum computing might eventually replace a lot of the finance world. David Graeber. David Graeber was an American anthropologist and political activist known for his academic influence regarding economics. He wrote 2 famous books. The first one is called Debt: The First 5,000 Years, where he delves deep into debt and its role in history regarding government and social structure. The second one is called Bullshit Jobs, where he postulates the idea of useless jobs and how they stagnate society. Both of these books were heavily praised and heavily criticized by various people. The reason for that is their radically different approach when it comes to describing the faults of society imposed by the economy. David Graeber was also a political activist with a clear stance against economic inequality, popularizing the phrase, "We are the 99%. David Graeber sadly passed away in 2020, but his heavy passion for economics and politics solidified him as a leading figure in modern left-leaning ideologies. Rental society. This refers to the rich and powerful hoarding more and more assets, driving up the price while gatekeeping the middle class from ownership. This is especially prominent in real estate. You have companies like BlackRock buying up lots of homes only to rent them out in order to gain passive income on top of the property's value. A classic case of the rich getting richer. There's a lot of speculation and fear surrounding this type of business practice. The main concern is that we will slowly become a rental economy where we don't own things anymore, we rent them, which is pretty much already happening. I mean, think of how many different kinds of subscription services there are for pretty much everything nowadays. Compare that to what we had 20 years ago and you'll quickly realize that the rental economy is coming sooner rather than later. City of London. A financial district in central London, the City of London is usually considered to be the British equivalent to Wall Street. It's a major target for conspiracy theories due to its very unique jurisdictional nature. The City of London is technically its own city within London, and all of London's major financial centers like the London Stock Exchange and the Bank of England are all inside this small district. The city is a plutocracy, and this means that businesses are actually allowed to vote. This combined with its banking secrecy raises a lot of concerns surrounding corruption and money laundering. In fact, the former Deputy Foreign Secretary Andrew Mitchell stated in an interview that 40% of the dirty money in the world goes through the City of London and other crown dependencies. I doubt the legitimacy of this statement, but it is alarming nonetheless. Rockefeller. I previously talked about old money nobility, and one of the most controversial old money families, at least in the US, is undoubtedly the Rockefellers. Their massive empire began with John D. Rockefeller, who founded Standard Oil in 1870. Standard Oil quickly grew into one of the largest companies in the world, making John the second wealthiest person in history. John would then go on to establish one of the oldest and wealthiest families in America, and let's just say that his family has been plagued with controversy. The Rockefellers are known for their ruthless business practices, but they are guilty of far worse. With everything from bribery to racial oppression, they have a long list of crimes against humanity. But easily the worst act in their family history is the Ludlow Massacre, where guards under Rockefeller command proceeded to gun down 21 people for going on strike. Despite these horrible acts of brutality, the Rockefellers still hold a lot of power through trust funds and politics even to this day. I can't help but think that it's not entirely fair. Hidden Nation Bonds. The Hidden Nation Bonds is a myth dating back to World War II. It's one of those hidden treasure legends similar to Yamashita's Gold and Rommel's War Loot. These legends became very popular after the war since many historical artifacts were lost as a side effect. But this one is even more obscure than the rest, and we don't even know if it's real, so keep that in mind. In 1942, Japan established the Wartime Finance Bank and the Southern Development Bank in order to raise funds for the war. These institutions issued billions of bonds that were rendered useless after their defeat. Some believe that the Japanese government kept a lot of these bonds hidden as a precaution. If this is true, and if these bonds would ever be found, they would likely hold a lot of historical value. Banks manipulating markets. This is a complicated topic that honestly deserves its own video because on some level, they do. They do manipulate markets, whether that's through reasonable means like a rate hike from the Federal Reserve or through straight up illegal ways like manipulating LIBOR. Remember earlier when I mentioned that we don't use LIBOR anymore? Yeah, this is why. A little more than a decade ago, Barclays and other banks were caught manipulating LIBOR through false rates, and there are many other examples of banks doing similar things, such as Goldman Sachs hiding foreign debt, or HSBC even lending money to known criminals. Yeah, banks are up to some pretty shady stuff, and they can get away with this because they are generally too big to suffer any long-lasting consequences. If something happens to a massive bank like JP Morgan, the whole world economy suffers to some extent. It's a corrupt world we're living in. And that's it. I want to give a quick shout out to Analyzing Finance with Nick. That's where I got the idea in the first place, and I wanted to make a similar video with my own spin on it, so if you haven't seen his video, go check it out. Like and subscribe. Peace.